A single invisible web stretches from Wall Street to Frankfurt to Shanghai. $300 trillion in global debt, binding the world's three great currencies together. It's midnight in New York. A trader stares at a screen watching the dollar index flicker as Asian markets open. In Frankfurt, a central banker sips coffee, eyes fixed on euro swap spreads. In Shanghai, a PBOC official scrolls through a dashboard of shadow loans, export receipts, and Yuan dollar cross rates. 3 cities, 3 currencies, 1 web. For decades, the dollar, euro, and yuan have been rivals, each vying for the crown of global money. But beneath the headlines, they're also trapped in the same system. A $300 trillion web of promises, contracts, and IOUs, so tightly woven that if one thread snaps, the whole world could shake. This isn't just about currency wars or trade deals. It is about the plumbing of the global economy. The dollar as the world's reserve, the safe asset in every crisis, the euro as the world's second anchor, a grand experiment in unity and risk sharing, the yuan, once a local currency, now a rising power, tied to global supply chains, shadow banking, and a new vision for money. But here's the catch. Every time one currency tries to break free, it pulls tighter on the others. Every time a crisis hits, whether in Milan, Shanghai, or Manhattan, the world's central banks are forced to play by the same rules or risk a chain reaction. What if the world's biggest risk isn't a single currency collapse, but a chain reaction? What if the next global panic isn't about who wins, but about how everyone is tied together? Coming up, the secret deals, the debt dominoes, and the new rules of global money. But to see how the web was spun, we need to go back to the moment when the world's money map was redrawn. Step back to 1944. The world is still at war, but in a quiet New Hampshire hotel, the future of money is being written. Delegates from 44 nations gather at Bretton Woods. The plan? The US dollar, pegged to gold at $35 an ounce, will anchor the world. Every other currency will peg to the dollar. The US, rich in gold and industry, becomes the world's banker. Picture the scene. Shipments of gold bars stacked in Fort Knox. American factories roaring, rebuilding Europe and Japan. The dollar is as good as gold, literally. For a generation, it works. The world grows. Debt is good. It funds highways, homes, and the Marshall Plan. The eurodollar market is born. Dollars held outside the US, fueling global trade. But by the late 1960s, cracks appear. The US spends on Vietnam, the space race, and social programs. Dollars flood the world, but gold reserves can't keep up. 1971, President Nixon appears on TV. He temporarily suspends gold convertibility. The dollar becomes a fiat currency, backed by trust, not metal. The world panics. Currencies float. Oil shocks hit. Inflation surges. But the dollar survives because there's no real alternative. Europe launches the euro, a bold experiment to unite a continent and challenge the dollar's reign. Picture the celebrations in Frankfurt and Paris. A new currency, a new flag, a new hope for stability. The euro's promise: end currency wars in Europe. Create a rival reserve currency. Bind Germany and France so tightly that war is unthinkable. For a while, it works. The eurozone grows. Debt is cheap. Southern Europe borrows to build roads, bridges, and dreams. But the euro is a currency without a country, no single treasury, no shared fiscal policy. Just a patchwork of nations with different debts, cultures, and politics. The global financial crisis hits. The dollar, battered but still king, becomes the world's safe haven. The euro stumbles. Greece, Ireland, Portugal, Spain, debt crises erupt. Bailouts, austerity, and political turmoil follow. Economic terms: reserve currency. The dollar's role as the world's anchor. Currency block: the euro's attempt to unify. Fixed versus floating: the end of gold, the rise of trust. The emotional echo: Europe's dream of independence becomes a story of codependence. The euro, meant to rival the dollar, is now tied to it by trade, by debt, by the need for dollar liquidity in every crisis. How did the euro go from challenger to codependent? Why did the dollar's power only grow as the world tried to escape it? But as Europe built its currency, another giant was quietly weaving its own thread into the web. Now, shift the lens to the east. It's 2001. China joins the World Trade Organization. Container ships leave Shanghai, stacked high with electronics, toys, and textiles. Dollars pour in, billions, then trillions, filling the vaults of the People's Bank of China. For a while, China's role is simple: the world's factory. The US buys, China builds, and the dollars flow back as China buys US treasuries. But beneath the surface, a new engine is revving up. The global financial crisis hits. Western demand collapses. China's leaders panic. Factories close, workers protest, growth stalls. The response? A stimulus on a scale the world has never seen. Trillions of yuan are unleashed. Local governments borrow to build highways, airports, and entire ghost cities. But not all this debt is on the books. Enter shadow banking, trust companies, wealth management products, off-balance sheet loans. Money flows through a maze of channels, funding everything from real estate to steel mills. By the 2010s, China's debt to GDP ratio is soaring, but growth is back. The world marvels at China's speed, while quietly worrying about the bill. For decades, the yuan is tightly controlled. Capital can't flow freely. The exchange rate is managed. But as China's global ambitions grow, so does its desire for a seat at the monetary table. Currency swaps with dozens of countries. The Belt and Road Initiative, infrastructure deals across Asia, Africa, and Europe, often settled in yuan. The launch of the Shanghai Gold Exchange and the Shanghai Futures Exchange, China's bid to set its own prices for metals and commodities. But the yuan is still not a true rival to the dollar or euro. It's not fully convertible. It's not trusted as a global reserve. Capital controls remain tight, yet the web is tightening. China's debt-fueled growth is now tied to the same global system. Chinese banks borrow in dollars to fund overseas projects. Chinese companies issue bonds in Hong Kong and New York. The yuan's value is watched by traders in London, New York, and Frankfurt. If one currency stumbles, the shockwaves hit all. By 2024, China's debt is a double-edged sword. It's powered a miracle, lifting hundreds of millions out of poverty. But it's also created a fragile system. Ghost cities, over-leveraged property developers, local governments with hidden liabilities. The optimism of China, debt's rise, feels disturbingly similar to the euphoria of the US in the 1920s or Europe in the 2000s, right before the cracks appeared. How did China's quest for independence make it more entangled than ever? What happens when the world's factory becomes the world's biggest debtor? But the real glue in the web isn't just trade or debt. It's the hidden plumbing of global finance. Now, step into the hidden machinery that keeps the $300 trillion debt web from snapping. It's September 2008. Lehman Brothers collapses. Markets freeze. But the panic isn't just in New York. In Frankfurt, traders scramble for dollars to settle trades. In Tokyo, banks can't roll short-term funding. In Sao Paulo, companies can't pay for imports. Why? Because the world doesn't just use dollars for trade. It borrows, lends, and settles in dollars even outside the US. This is the eurodollar system. Trillions of dollars created and traded offshore, outside US regulation. European, Asian, and Middle Eastern banks all need dollars to function. When the crisis hits, everyone needs dollars. Fast. In the chaos, the US Federal Reserve does something unprecedented. It opens swap lines, emergency lending facilities with the European Central Bank, Bank of Japan, Bank of England, Swiss National Bank, and others. Picture midnight calls between central bankers. Can you send us $50 billion by morning? Done. We'll swap euros for dollars at the Fed's window. These swap lines are the world's hidden safety net. They keep the web from unraveling, but they also reveal just how dependent the world is on the dollar KES plumbing. Since 2008, every crisis is now global. A debt scare in Italy, the ECB calls the Fed for dollars. A property developer defaults in China. Asian banks scramble for dollar liquidity. Sanctions on Russia. The world's dollar pipes are rerouted, but the need for greenbacks remains. The eurodollar system is now so vast that no one knows its true size. Estimates run from $13 trillion to $30 trillion or more. Economic terms, swap line, a central bank to central bank loan, usually in dollars to provide emergency liquidity. Eurodollar, dollars held outside the US, often in European banks. Liquidity crisis, when everyone wants cash and no one wants to lend. The web is now so tight that a shock in one currency can trigger a scramble for liquidity everywhere. If the dollar spikes, emerging markets with dollar debt suffer. If the euro wobbles, European banks pull back, cutting credit lines worldwide. If China's shadow banks freeze, commodity exporters from Brazil to Australia feel the pain. The panic of 1929, the chaos of 2008, the uncertainty of every modern crisis, each moment feels disturbingly similar to the fear that the system's hidden wiring is about to short circuit. Why does a crisis in Milan or Shanghai always end with a call to the Fed? What happens when the world's safety net is also its biggest risk? But as the web tightens, the world's biggest players are quietly preparing for a new kind of currency war. For decades, politicians and pundits have promised that their currency, dollar, euro, or yuan, could go it alone. That if things got bad, they could decouple, insulate, or even dominate. But history tells a different story. In the gold standard era, a crisis in one country could be contained, at least for a while. Currencies were anchored to metal, and capital controls kept money from fleeing too quickly. But in today's world, everything is connected. The 1997 Asian crisis, Thailand's devaluation triggers a domino effect across Asia, Russia, and even Latin America. The 2012 Eurozone panic, A Greek default threatens to unravel the entire euro project, sending shockwaves through global banks and bond markets. The 2022-2024 BRICS de-dollarization push. New payment systems, commodity-backed trade, and currency swaps are all attempts to escape the dollar AS gravity. But each move pulls tighter on the web. Every major player is both a rival and a hostage. The US dollar is the world's reserve, but its strength can crush emerging markets and even threaten US exporters. The euro is a grand experiment in unity, but its weakest links, Italy, Greece, Spain, can threaten the whole bloc. The yuan is rising, but China's own debt and capital controls mean it can fully replace the dollar or euro. Yet, economic terms, currency war, competitive devaluations, tariffs, and capital controls to gain advantage, debt spiral when rising interest costs force more borrowing, leading to crisis. Contagion, the spread of financial panic from one market to another. Every time a crisis hits, leaders talk about decoupling, building walls, creating alternatives, going local. But the reality is that every major player is tied to the same web. US treasuries are held by China, Japan, and European banks. European banks lend in dollars and yuan. Chinese companies borrow in euros and dollars to fund global expansion. A shock in one thread, whether it's a US rate hike, a Eurozone default, or a yuan devaluation, can send tremors through the entire system. The Panic of 1929, the gold confiscation of 1933, the Eurozone crisis of 2012, the COVID shock of 2020, each was a test of the web. Each time the world survived, but each time the cost was higher, the recovery slower, and the next crisis closer. Today, the risks are bigger and faster. Digital money moves at the speed of light. Derivatives and shadow banking hide risk in places regulators can't see. Geopolitical tensions mean that a financial shock can quickly become a political one. The myth is that you can decouple, that your country, your currency, your savings are safe from the web. The reality is that every thread is pulled tight. Don't assume the rules of money are set in stone. Watch for the signals: rising distrust, capital flight, sudden new laws, or capital controls. Diversify. Not just your assets, but your understanding of how systems can change. Pay attention to the canaries, real yields, central bank gold buying, spreads between paper and physical prices, and odd divergences between East and West. In every reset, someone is early, someone is late, and someone never even realizes a reset happened. Will you be ready when the next thread snaps? Will you recognize the signals before the headlines hit? The answers are hidden in the past, if you know where to look. Subscribe for more cinematic economic history and learn how to spot the next global reset before it hits. Next time, the forgotten currency that almost broke the web.